We have seen the biggest repricing that anybody has expected, I believe, for software as a service companies.
It's all about small caps this episode. On one hand, they're outperforming, but under the hood, smaller software stocks are being trampled.
It has been very challenging to figure out who are the winners, who are potential losers in this game.
We've got Andrey Omelchak of LionGuard Capital, who focuses on small and mid-cap opportunities outside the resource sector. Electrovaya, did I miss the boat, or is there still some upside?
You have not missed the boat.
For both Thomson and Constellation, you would be a buyer. With all of the interest now in small caps, have they gotten too expensive? Is it harder to find these opportunities? When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. In this episode, we discuss Constellation Software and GoEasy, which are both stocks that I own. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. It's already a pretty chaotic start to the week. Investors are trying to figure out what the geopolitical fallout is from the attack in Iran, how permanently it will reshape dynamics in the Middle East. We're seeing reactions in global equity markets, a lot of volatility and pressure there, obviously a big spike in oil. It's against this backdrop that we spoke with Andrey Omelchak. He is the CEO and CIO of LionGuard Capital. He actually doesn't play in energy or resources at all. He plays in small and mid caps. But typically when these events happen, you have kind of a sell first, ask questions later mentality. He says that any selling pressure on the back of geopolitics would be a buying opportunity. We also take a look at the sector more broadly. Small caps are having a moment, which is why I wanted to talk to Andrey in the first place. They are outperforming large caps. We speak about why that is and whether that can continue. And he's not kind of a perma bull on a bunch of these stocks. He's pretty clear about ones he's avoiding and ones that he would pick up, particularly in software, because this has been a large cap and a small cap story. AI, with all of these new releases, there are investors who are very nervous about disruption in the software sector and whether or not these business models have been made obsolete like that. So he talks about names that he would get in front of, ones that he would be patient with, ones that he is worried about. So again, another classic stock picking episode. And we love to hear from you. We've got our swag giveaway going on. I've got my market cap hat that you can already see if you're watching on YouTube. Goes very well with the pink peplum top. And we are giving it away with our liquid assets mug. So simple. All you have to do is be a subscriber, subscribe wherever you're listening, and comment wherever you are listening. I've been loving the comments so far, and we're picking one winner from each episode that will get this combo. And Andrey, when he was in the studio, he was looking at our EBITDA sweatshirt, which I love. And people stop me when I wear this and saying, you know, classic money manager, he's like, EBITDA, it should be cash flow. So maybe that's something we'll do after this giveaway is we need a cash flow sweatshirt and a cash flow hat. Okay, you know what to do. Comment like wherever you're listening and buckle in because we've got a great episode. Let's get into it. Andrey Omelchak, thank you so much for joining us on the podcast.
It's great to be here, Amber. Thank you.
Let's introduce you to the audience because you have a neat little sandbox. You're not looking for large cap ideas. You're small and mid cap, but no commodities. Is that right?
That's right, exactly. So when I started my career in finance, I decided to focus on a niche where I can find a lot of inefficiencies. So small caps, mid caps is where you can find a lot of inefficiencies. Actually, it's the Warren Buffett saying, if you give me $1 million to manage, I can guarantee you 50% return, but I would invest in small caps because that's when efficiencies exist. That's what got me interested to focus on that market niche. So yes, I like small caps and mid caps, and we invest across North America. And we stay outside of resources complex because of inherent unpredictability of commodity price movements, which determine a lot of the pricing for those stocks.
I mean, that's too bad for me because I would love to ask you about the oil price move that we're seeing on the back of Iran. Obviously, this week, the world readjusting, if we can call it that, to a new reality in Iran. The U.S. and Israel has invaded Iran. And even though you don't own commodity stocks, as a small cap investor and a mid cap investor, I'm curious how you digest news like that, where the initial reaction is panic. You see a lot of pressure broadly on equities, upward pressure on commodities. But how do you think about either the near term or the lingering effects in your universe of those kind of events?
Well, this is a major geopolitical change, and I've commented in the past that we live in a very different geopolitical environment. Over the last 12 months or so, the world has changed. And these latest developments are leading to the whole new level of the geopolitical changes. A typical reaction during such military action is that market sells off somewhat, but actually it's a buying opportunity because there's so much investments happening in defense sector, in all types of domestic activities to make sure that military might is there to defend yourself. So typically, it's a buying opportunity when it comes to stock market investors. Of course, we all hope for the minimal, casualties on the civil front, and unfortunately, innocent people are going to die. I think the reaction, as we see now, some increase in gold price is very warranted. Of course, that's a safe haven where you go. Increase in oil prices is also very warranted because Strait of Hormuz represents approximately 20% of the energy transition globally, and that 30 kilometers or so is critically important. So as of now, we're seeing movement of vessels, but at much reduced pace. And if that freezes, that's going to lead to the major spike in oil prices. But in my books, this is all temporary. It cannot last forever for sure. So if the oil spikes, above $100, which is very possible in my books, it's not going to stay there for an extended period of time.
And you've seen periods like that before. What effect, or is it always different, does it have on interest in the small cap sector? And I ask that because right now, well, at least leading up to this, we've been in a situation where small caps are outperforming large caps. There is what appears to be sustained interest in your sector.
That's correct. Small caps have been mispriced relative to the large caps. You can make that argument. And large caps, especially US large caps, have been driven by Magnificent Seven to the large extent. So there's a catch-up that's starting to take place. This particular event in Middle East is not positive for equities in general, and probably is even less positive, even more negative for the small caps, because that would lead to potentially interest rates not going to get cut because that's inflationary. So that's the biggest negative. The biggest question here is how long this will last. If this lasts a few weeks, it's not going to be a big event as it relates to the small cap equities and overall impact on the global GDP growth rates. If it lasts longer, that can have a more pronounced effect, and that would lead to the more negative repercussions that potentially for the smaller cap equities.
It sounds like, though, that's not your base case. You remain invested and looking for opportunities?
Absolutely. I believe in investing for the long term in small caps and mid caps as well. there are always opportunities out there. There are thousands of securities to choose from. And some are benefiting from those dynamics, unfortunately. And there are always mispriced assets. So we take advantage of these type of events to make sure that we protect the capital, but also multiply the capital.
So that's my question actually on valuation. With all of the interest now in small caps, have they gotten too expensive? Is it harder to find these opportunities?
We see tons of opportunities in small and mid caps. Of course, you have to look for them. You have to know what to look for. Market dynamic has changed tremendously over the last several quarters. It's a very different market from before. It's a very short-term focused market as well. So, in fact, if you can invest the capital for 1 year or longer, you have a major competitive advantage relative to a lot of other asset managers who are focused literally on 1, maximum 2 quarters away today. So if you can have those type of lenses, if you can look at securities and try to predict what they're going to be, what the economics are going to be 12, 18 months into the future, I think you have a major advantage.
Well, let's use broadly a sector as an example of that. Software, even small cap software, or maybe I should say especially small cap software, has been effectively, it's a kind of a shoot first, ask questions later type of vibe. It seems like no software stock has been spared because we have just been getting this onslaught of new developments coming out of these AI platforms that, it disrupts legal, it disrupts cybersecurity, now it disrupts the financial sector and the exchanges. How have you been dealing with that? How have you been processing that?
It has been very challenging to figure out who are the winners and who are potential losers in this game. So we have seen the biggest repricing that anybody has expected, I believe, for software as a service companies. If you go back 12 months ago, the perception was that these are the best businesses you can find globally. You have a recurring monthly subscription revenues. They can increase prices on an annual basis. Usually it's GDP plus type of increases, inflation plus. So great businesses, highly sticky, but the world has truly changed. And now a lot of investors think that these companies are challenged by artificial intelligence developments. Their business models are not as sustainable, and their moats are not the same as they used to be. In my opinion, there's a lot of misconception there, and you really have to dig further to understand the underlying business. Some businesses, in my opinion, number one question is how long it takes to integrate this type of business. If it takes months and quarters to integrate their solution, if you're truly entrenched in underlying company's operations, if it's very heavy on operations, compliance, addressing special cases, then you have something unique. It's very difficult to rip you off and replace you with a software solution that somebody else has developed.
But maybe you don't buy the add-ons, right? You don't renew, a couple years down the road. I think I hear you on that, but it's something that, where before maybe there was no alternative to whatever this expensive software was. If you're a CTO, you're looking, well, in a couple of years, I could see that there is an alternative. And so your long-term plans start to change. Isn't that a risk worth pricing in now?
That's what a lot of market participants are thinking about. And you're totally right to point at that. But the question becomes, are you well entrenched or not? If you're doing very basic solution at the high level, you can be easily replaced for sure. So those business models are prone to major disruption. If it takes a lot of time to integrate this company's solution, they actually are net beneficiaries of those developments, in my opinion, because they can innovate using artificial intelligence and provide additional software solutions and modules for which they can charge.
Okay, well, let's not talk about this in the abstract because we have a lot of specific companies that maybe we can apply this lens to. Let's dip into the mailbag. Okay, we'll start with the darlings in the mailbag and work our way down to some of the smaller caps. People have a lot of questions about holdings that have served them well for a long time. We have a question from David in Markham who wants answers on two stocks, both Thomson Reuters and Constellation Software, saying we've seen a notable drop in major software companies like Thomson Reuters and Constellation, investors trying to figure out how AI might disrupt traditional software business models. And the question goes on, but basically, is this a buying opportunity? Is it a temporary pause in a broader repricing of software valuations? I think that's an interesting question.
It's a great question, and especially in relation to the two very high quality companies, Thomson Reuters and Constellation Software. Of course, they're both M&A consolidators. They both used to trade at very high multiples, which means that everybody perceived them as super high quality, very recurring. It is a difficult question to answer overall, but I would think that it's a buying opportunity for this type of businesses because a lot of their solutions are truly entrenched with the underlying clients. They're heavy on proprietary data as well, as it relates to Thomson Reuters in particular. Data that is not replicable by a software solution that can be made by artificial intelligence. I think there will be net beneficiaries, especially Thomson Reuters, as they tend to innovate on the back of AI developments and to offer more solutions to the underlying clients. But then you have to look within each underlying vertical. So, for example, within the legal vertical, there has been developments about the legal solution provided by Anthropics, I believe.
Yep.
It remains to be seen whether the legal professional will be completely changed or not. But clearly, some of the rates charged by the lawyers, they will not be present, or the billable hours will drop quite a bit. So that changes the offering that they provide to the marketplace. Now, I want to speak briefly about Constellation Software. So there are two questions here. One is the underlying business today. Is it prone to disruption or not? Can you expect the same level of free cash flow generation or not? And the second question is the M&A opportunity going forward. So on the current business front, it's a highly diversified enterprise. There's 1,000+ companies within the Constellation ecosystem, many addressing very small niche solutions. Therefore, to invest a capital and money in that, to go after those clients, it's not really as interesting as going after the bigger markets, like a legal profession, for example. And what I'm confident about is that Constellation management team are not sleeping at the wheel. They're heavily investing in finding how to monetize artificial intelligence developments across all the portfolio companies. So I think that is happening. And they're going to actually have their first conference called by Constellation Software this month. So everybody's super excited about that, myself included. And we're going to get more insights into what they're doing about artificial intelligence developments.
Now, you asked a question about M&A. Constellation Software, that had been a little bit of a challenge as they'd gotten so big. Where are the deals? Are they able to find as many deals? Now everything is being repriced lower, even Constellation, but so too are maybe some potential targets. Is that how you're thinking about growth going forward?
So last year was the second biggest M&A capital deployment year for Constellation Software. So far, they have not had any problems deploying the capital, as far as I'm concerned. And I think this environment provides them with a lot of opportunities to deploy more capital. Market multiples have corrected quite a bit. I think they will start getting more involved in the public markets as well, as we have seen some of the developments recently. They're looking at some of the public entities. For example, Topicus, one of the companies majority owned by Constellation Software, has a minority stake in a public company. And I think we should not be surprised to see...
you think they could just bring that in-house, Topicus?
I think they want to remain minority shareholder in that public entity out of Poland, I believe. But I believe you're going to see more M&A announcements of public companies by Constellation ecosystem because public multiples have compressed a lot.
So there's another question about what is the right multiple? Do you think it's what it was before all of these AI innovations?
Well, I think the multiple will remain compressed, absolutely, relative to the past multiples, because the fear of AI disruption is not going to disappear overnight. It takes a number of quarters, potentially a couple of years, before the market will get comfortable that software as a service businesses, and Constellation in particular, have adapted well to this new market environment and actually is taking advantage of it as opposed to being disrupted by it. So I don't expect multiple to go back to the prior levels, but I do expect an acceleration of M&A activity. At the same time, they're not giving anything in terms of their discount rates. So the discount rates remain very high when they make an acquisitions. They're not paying much for the terminal value at all because the benefits have been front-loaded over the literally first 4 or 5 years because of the high discount rate. And that's a huge differentiating factor. So as a result, I think they can make a lot of acquisitions.
So it sounds like for both Thomson and Constellation, you would be a buyer.
I would be a buyer on the weakness of both companies. I think these are phenomenal enterprises. And I think even though some verticals within Thomson Reuters can potentially get disrupted, overall, it's a super high quality company.
I mean, these companies less than a year ago hit record highs. And since then, they've been cut in half. They're down. So I guess, should we caution investors? You can buy this dip, but the jury's still out, which might mean there could be another 20, 30% downdraft in these stocks?
Absolutely. I mean, they can correct further. I don't know exactly how low the multiples can go, but at this point, you're not paying much for terminal value for Constellation software at all, and you're paying very little for Thomson Reuters. But when it comes to mark-to-market and market panicking around tech companies and AI disruption, absolutely, we can get another 20% correction. It's very possible.
Okay, buckle up. What about in the small cap space? We've got questions on Docebo and Neat.com. I'd love to hear Andrey's thoughts on both of these companies. They've had a huge drawdown and really chalking it up to the software space being beaten up. Do you want to stick to large caps and high quality, even though you're a small and mid cap player? Or would you even look at some of these stocks?
So it's really case by case.
Mm-hmm.
And that's why I think right now you have to be a fundamental investor and really understand the underlying businesses. Docebo, I have been skeptical on for quite some time, as a matter of fact, because I don't believe that the barriers to entry are as big as the market perceived, even going back 2 or 3 years. In this type of environment, Docebo has corrected a lot. And I remain a bit skeptical on whether or not they're as differentiated and as sticky as some of the investors are hoping. They are making the right steps, though. They're buying back the stock. They're sending all the right signals. They're commenting that there will be acceleration in organic growth rate, even though they're experiencing some deceleration right now. I think the jury is out whether or not they're as sticky as they want to be or not. So I would be a bit careful on Docebo.
What about Neat.com? Do you know much about that? I'm not as familiar.
Yeah, Neat is a small cap company, trades on Toronto Stock Exchange. It's exceptionally high quality business, in my opinion. This is an example of a technology company, software as a service, which is actually very much integrated into the underlying company's operations. They work with the world's biggest pharma companies, and they help them to optimize the whole path towards getting the drug into the market. It's a very, very complex process, and they help to make sure all the steps comply with the regulatory compliance, and all the steps are properly optimized. It's a very lengthy implementation process. Some of the world's biggest companies work for them. I don't expect Neat to be displaced by AI at all. I think it's a major buying opportunity, actually, for this type of business.
Now, your fund, you run long and short. And I know people don't like to talk about their shorts, so I won't make you talk about your shorts as much as I would like that. But I'm curious, there are obviously names that you're picking up on the dip, but within this sector, are you also shorting? Is the short book bigger than the long book in software? And maybe you could shed some light on, if you won't name names, criteria. You know, what's a good software short right now?
It is not easy to find a software short these days.
Because it's already
I would
done.
say because it's too hard to say whether the company is truly prone to disruption or not. But from time to time, we find businesses which we believe are still overpriced. And this whole witch hunt around which companies are prone to AI disruption, I think we can identify some subsectors within the technology space which have not yet been targeted, but we think should be targeted, as a matter of fact. So there is some of that we can do on the short side of the book. But you really have to be careful these days when it comes to shorting as well.
Okay. Oh, just name it. Can you name one? You won't name one.
We don't like to publicly discuss our short ideas. And the reason for that is because we want to make sure we have access to management teams.
Yeah.
We want to make sure that they come to our office. Typically, we have 350, 400 one-on-one meetings with management teams per year. It's very important to us to understand what the companies are doing. As a result of that, I want to make sure that we have access to all the information we need to manage our capital. But what I can tell you is that if it's the world has changed in that something that was perceived as being very safe is now being perceived as being very risky.
Mm-hmm.
And on the opposite side, something that is boring and old school and old economy is now actually being viewed as a safe place to be. And I think that should give you some ideas of how we think about the long and short books.
Well, we'll get your longs in the Pro Pick segment. But one area, just to move through the mailbag that has been hit, and it might not seem intuitive at first, is kind of these engineering and construction companies. You think, okay, they play in the hard economy, the building out of infrastructure, and yet names like Stantec, AtkinsRealis, WSP Global, which we've got questions about, have all been run over on this AI scare. Maybe AtkinsRealis to a lesser extent because it does have a nuclear component, and that part of the business is growing. But what do you make of the AI threat being applied to this sector?
I think overall, it's very much misplaced. These are strategically important businesses that are very difficult for somebody else to come in, use an AI solution that they developed in their garage, or even if it's well-funded, and to go to the end clients and to tell them, now we can do something for you that Stantec is doing, for example. It's exceptionally difficult to do that. I think the bigger question is, what's the impact on billable hours? Mm. So the billable hours impact should be there, in my opinion, especially for the plain vanilla type of initial assessment applications and analysis. And it's very difficult right now to assess what's the impact on billable hours and, as a result, impact on revenue. But at the same time, they get to benefit from AI development to the large extent. I think it can be positive for the margin profile for the rest of the business. And I think these are exceptionally smart companies that are not sleeping at the wheel and adapting in this world. Having said so, the multiples have corrected somewhat, but given what I have seen elsewhere, this witch hunt, what is being disrupted by AI, I'm not yet a buyer of these businesses on this dip.
Because it is just a dip. It's only like a 20% pullback for right. WSP versus a total washout in software.
I believe potentially further pullback is very possible. They're not yet in this dirt cheap category. Mm-hmm. And should they get there, I would absolutely be buying them at those levels.
Okay, so wait and see on some of those firms. We got a question on Electrovaya, and the stock has performed well over the last year, seeing some recent positive news on orders and client wins and analyst upgrades. Did I miss the boat, or is there still some upside? This one coming from Tina. Electrovaya maker of lithium-ion batteries.
That's right. Thank you, Tina, for the question. You have not missed the boat, in my opinion. It's a great company. And they have operations in Mississauga in Ontario, and they're also building a gigafactory in New York State, which will triple their manufacturing capacity. They're exposed to all the right verticals right now. So defense industry applications. Mm-hmm. They just announced a couple of contracts with the defense industry. No names, but we know it's a good-sized contracts, and potentially there'll be more other ones based on the last conference call disclosures. Also, robotic applications. There's a booming industry for them. They work with some of the world's best companies. Think of Walmart. I believe Amazon potentially is their client as well. They work with Toyota, Raymond as well. So great lithium-ion batteries in a booming industry. Best track record on safety, on length of the usage of the batteries, how many cycles you can use the batteries for. So that's very important as well. And
it's a stock that's up in 2 years, like over 460%. So that's what Tina wants to know.
Sure.
That's a big thing that's in the rear view. And Electrovaya, I mean, I always hear of this name. It's not a new kid on the block. It's very cyclical. It has its moments every 5 to 6 years. And then it does have the capacity to implode almost as quickly as it rallied. How would you characterize, I'm curious how long you've been following the company, but how would you characterize what Electrovaya is today compared to even 10 years ago? And has it matured?
It's a completely different company. I've been following Electrovaya for about 8 years, actually. And I just invested last year for the first time. So it takes a while sometimes for the investment thesis to really come together. And it really has this time. So it's highly predictable, fast growth for the company right now. The gigafactory in Jamestown, New York, I believe will be filled to capacity very quickly. It is coming at a higher margin profile as well. The leadership team is very good. The CEO is, in my opinion, is quite exceptional. He has a PhD in material science from Cambridge University, so he speaks the same language as some of the buyers of those batteries. They understand the technical specifications required by the end clients. I think they are really, really well positioned, especially as it relates to the competition. A lot of the competitors are cheaper, but much lower quality Chinese-made battery manufacturers. I can assure you that mission-critical large companies, as well as defense companies in the United States, as well as elsewhere, don't want to buy a cheaper Chinese-made batteries right now. So they're really at the right space at the right time, and they're benefiting from those dynamics. We spoke earlier about the geopolitics and what's happening. So clearly, Electrovaya is benefiting from those dynamics, as well as the whole bring manufacturing back domestically, especially in the United States, where they also getting 45x tax credits for the facility they're building.
How important is defense today? How important does it become for Electrovaya in an environment where defense certainly is benefiting from a boom in activity, let's call it, but spending?
So defense is just one of the segments in which they operate. It used to be pretty much non-existent, and now it has become a sizable segment, literally as of the last quarter. And it's poised to become much bigger business this year in fiscal 2026.
And is that why you're buying the stock for defense, or there's other things too?
No, there are many other things happening. So robotic applications. Imagine the warehouse where the robots move things around. Imagine big Walmart warehouse. The robots are moving things around. There's no people working there, very few people, as a matter of fact. So Electrovaya powers batteries for these robots. And safety is critically important because if the battery explodes or goes on fire, I mean, it's a major incident.
Which has been known to happen.
Which has been known to happen, but it has never happened in the history of Electrovaya. They have the best safety record in the industry, and that's why they're trusted by those companies.
You know, speaking of defense as a theme, we've also got a question on Build Canada as an investable theme, which does include some initiatives around defense, but it's also infrastructure, housing. And the question is, who do you think in the small and mid-cap space benefit the most? This one coming from Brad in Hamilton is, I don't often think about Canadian policies as directly investable, but do you?
Well, first, thank you, Brad. Great question. I want to start by saying that I believe Canada needs to do much more. The sense of urgency is not yet present. I think we need to do 5-10 times more than what we are doing. We really need to wake up to the new world order, geopolitically speaking. We need to invest domestically. We need to make sure that we remove the regulatory hurdles to getting things done in a big way. We haven't had a proper commission on the Canadian competitiveness since, I believe, 1970s. The world has changed since then, I can assure you. Our competitiveness in Canada has dropped a lot. Per capita, it has been dropping for the past 15 or so years. It is very sad, the state of the Canadian competitiveness, and we need to wake up and to invest in ensuring that our competitiveness and growth per capita is present. Otherwise, we're going to be left behind. So, having said so, I think Canadian government is taking the right steps, finally, and in a sizable way, to invest domestically and to build Canada. So there are a lot of beneficiaries of those, especially small and mid-cap companies in which I specialize and focus, which will make a lot of money on the back of this, finally.
And I think you brought some of those ideas in your Pro Picks, is that right?
Yes, I did, yes. I have a number of those ideas. One of them is one of my topics. I'm happy to discuss it now or later.
Later. We'll do it later.
Sure.
Okay, so we'll call that a tease. Brad, you have to pay attention to Pro Picks because I want to just squeeze two more in from the mailbag and then we'll get to your Pro Picks. One question, I think there's a lot of retail interest in this, kind of separate from everything we've talked about. Well health. Is it a top 10 undervalued small cap on the TSX? Do you see catalysts in the future? This one coming from Gordon.
I like Well Health. I'm a current shareholder of Well Health. I believe they're doing all the right steps.
This is like a roll-up for health clinics plus a bit of a digital twist?
That's right, yes. So I think what's happening is that Well Health has a lot of different businesses. And people are confused, what am I investing in exactly? Some businesses are doing well, other ones not doing so well. But finally, management team has said enough is enough. We are going to streamline our operations. We will divest US operations to make sure this is off the books. As a result, our financials will be much cleaner and much more transparent. Also, they intend to IPO Wellstar, which is the digital division that provides all these tech solutions to the clinics. This is happening this year, I believe. So this will provide a nice monetization and unlocking of the value for the company. And as it relates to the roll-up of the Canadian health clinics, that business is doing really well. They just provided the latest data. Things are on track. Their pipeline to deploy capital is at record high. They do have also the balance sheet to do that. It's a profitable, high return on invested capital business. And I believe if done right, this can become a major compounding machine focused on the roll-up of those clinics.
Now, talking about underpriced assets, it doesn't seem like anything you've mentioned has shown up in the stock. In fact, it's the opposite. The stock has been under pressure, especially, from the fall of last year. Why do you think none of those catalysts are being contemplated in the stock right now?
In this case, my explanation is that everybody's focused on the next 3 to 6 months. The compensation structure for fund managers in Canada has changed over the last several years. And they're getting paid their bonuses based on performance of 1-year results, sometimes 6 months results. There has been a sea change, especially for pension fund managers, whereas they're no longer paid on a performance on 3 years and 5 years. If something is not working right now, they don't want to be investing in that stock. Actually, for those who know what they're doing, this is a major opportunity you can take advantage of. So, Well Health, the monetization of US assets is taking some time. They want to make sure they get the right price. They find the right buyer. They're not going to sell it for garage sale prices, which I think is the right step. So this will be happening this year, in my opinion. we're going to get those positive developments, but they haven't happened by December of last year, and some investors don't have the patience to wait.
That's really fascinating about how your industry is changing and maybe driving some of these stocks to be increasingly orphaned. They were already likely to be orphaned because Canada is small when it comes to the pool of investors who look specifically at this.
There has been a real separation between the investable assets, the companies that are working today, and then there is everything else. And everything else has been used as a source of capital to invest in companies that are working today. And of course, what's working today, we spoke about defense themes. We can also discuss some shortage of electricity, power infrastructure. So these things are working today. Everybody understands that. And all the capital is flowing here, as well as some resource complexes like gold, for example. But there's a huge pool of securities here which are being left behind. And among them, if you can wait 1 year or maybe 18 months, you can find a lot of bargains right now.
So let's talk about that as it applies to the fintech Propel Holdings. This has been beaten up, kind of an online lending platform. I'd be interested to learn about your views on Propel Holdings. This question coming from Kevin on X. Is this one of the stocks you think are sort of unfairly penalized, or do you think it's appropriately priced?
I believe it's unfairly penalized right now. I'm a big fan of Clive, the CEO, as well as Sheldon, CFO. They're great guys. They're true entrepreneurs. They know how to run the business well. So it's an A-plus management team, in my opinion. At the same time, we're hearing so much negative news about individuals' capacity to service their debt. Unfortunately, there has been a K-shaped type of economy where wealthiest people are getting wealthier, but I would say 75% of the rest of the population are struggling more and more. Propel lends money to people that are truly in trouble at the high interest rates, and they charge appropriately for that. Part of their money is never returned back, so that's normal part of the business operations.
But is that percent of their money that's not returned back growing because of strains in Canada's economy?
It hasn't been growing that much. So Propel has pressed on the brakes in August and September of last year as it relates to their origination activity, because they saw some cracks. They saw that non-performing loan formations started to increase a little bit. And so therefore they pressed on a brake. Now, if you think of yourself as a business owner, that's exactly what you would do. Now, the public markets did not like at all the fact that origination activity has slowed down and penalized the stock a lot. But I told the management team, if you are running a private business, what would you do? They said, we would do exactly that. And I said, that's what I want you to do.
So it's okay to slow down originations if the risk profile is too risky.
Absolutely, absolutely. Subsequently, they got more comfortable. Now they're originating more. What I like about Propel is that they can quickly press on the gas. They can originate more, and they can quickly slow down. You're not lending for an extended period of time. This is not like a lengthy insurance company where you're committed on a 10, 15-year obligation. You can truly adjust the business as you go along. So I think the management team is doing all the right steps to manage the business properly. At the same time, I think it's challenging in this environment where consumers getting more under pressure to warrant a high multiple for this type of company.
But would you say it's a high multiple now that it's pulled back?
I don't think it's a high multiple at all.
A similar stock that has been kind of run over and plays in the same-ish space is GoEasy. Do you have is that a name that you would pick up? It has the additional issue of the fact that, well, there's new management in place at a time that there was a short report. How did you assess that?
They just discussed Propel, and I said the management team is A+. And then as it relates to the GoEasy, management team has made a number of mistakes. And the issues are real, and they're addressing them. But I think it's too early to tell whether we have seen the worst of it or not. I think we need to see their 3-year targets, which they're probably going to communicate shortly. And this will tell us quite a bit about what's happening. But there still can be negative surprises, in my opinion, so you have to be careful. Historically, this has been a phenomenal company, a great compounder. can they keep growing their earnings per share at a fast clip? Are they going to run into some lending issues? They have diversified into the other loan books where some issues popped up.
Is that the mistakes you're talking about?
I think it's a mistake for them to get into that into that line of business. I think you have to stay true to what you're truly expert at, and I don't think they have done a great job in that particular business.
Probably because why? Looking for growth, right?
They try to grow the pie, but in reality, their total addressable market already is very high within the niches in which they operated, so they didn't have to go there. Maybe collection wasn't great. It was difficult to collect the cars, that are non-paying. So there are some technical matters around it which make it look even worse. But having said so, I think you have to be careful. You have to make sure that the numbers are good and clean. Management team is committed, see a few quarters of good numbers, and then you can have the comfort level to start investing in it again. And I don't think you're going to miss the opportunity. It's not like the stock will rally 100%. Highly unlikely, in my opinion. It's okay to forego the first 30% movement upwards, but have a much better risk-adjusted return profile for the business.
All right, great perspective. Low conviction there for now. Let's find out where you do have conviction and get into your pro picks. Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, so earlier in the show, we talked about Build Canada as an investment theme, and you said, well, I've got a stock that reflects some of the infrastructure spending and defense spending that is being undertaken by the Canadian government. So that brings us to your first pick, which is Calian Group. Definitely more of a play on defense. Is that right?
That's right. More than 50% of Calian business is actually defense and defense-related industries, yes.
Now, the market's kind of aware of that. The stock has had a really nice rally. Talk to me about how the business has grown as a result of this strategic imperative and where you think it can go from here.
Well, I think defense theme as an investment is one of the most obvious investment themes for me right now. And it's starting to be reflected in the Calian valuation. But I think there's much more to come. They have streamlined some of the segments reporting last quarter. And now defense and defense-related is more than 50% of the business. I think that business can have a higher margin profile. So I'm very excited about that. Calian is communicating that they intend to grow their revenue and EBITDA at 10 to 15% per year going forward. Those are their 3-year targets. I think those are quite achievable. And some, I think they can expect to see a multiple improvement as well for the company, given the multi-year visibility on the defense and related industries.
I think that's the debate around the stock right now. It's a under $1 billion market cap, but if it goes up a little bit more, it'll become a $1 billion company. But it's at a record high and trading at a premium to its historical trading range. So when you're recommending it at kind of that record high, stock's already gone parabolic. What kind of multiple do you think is reasonable? Because I'm just looking at estimated. It's already trading at 20 times.
Well, 20 times earnings, I think for this type of business, given the visibility, is fair. And in fact, earnings are gonna keep growing higher. I think free cash flow conversion is going to improve quite a bit. It is paying a nice dividend as well. It has cybersecurity business. It has military training business. It is working with the NATO countries as well as Canadian military. I think this business can trade at 20 plus times earnings and probably can trade at 12 times plus EBITDA and should be expanding from that point on. So I don't see any need to reduce it because of the recent runoff. And it is indeed my top pick because the visibility of the business has improved tremendously.
And Ottawa-based, I imagine it doesn't hurt that Canada has said we're going to buy Canadian when it comes to their own supply chain.
Well, there's a buy Canadian and there's also investment in defense. Our defense budgets are growing at a very nice clip year over year. And there are a few companies in Canada which will benefit from that. And Calian is certainly in that list. They will be, and they are, direct beneficiaries of the booming defense budget in Canada, as well as in Europe for some of the NATO countries.
Another idea you've brought to us is bird construction. And this one has held up remarkably well, and it's off to a very strong start in 2026. What first introduce us to the company, and then what you see as some of the green shoots here?
Yeah, so Bird is a construction and engineering services company. 100% of their business is Canada. And this is the most direct Build Canada exposure I can think of among the companies that I have studied. They have a booming backlog. Over the past 12 months or so, the backlog is up by more than 40%. Also, the backlog is coming at much higher margin. So the margins are poised to increase. Also, the quality of the backlog is improving not only on the margin front, but also on the risk front. Now they're doing projects in partnership. They're not taking as much direct risk. So I expect them not to have as many missteps as in the past. So you have a booming backlog. Mm-hmm. It's a Build Canada direct exposure, margin improvement. There's going to be free cash flow conversion improvement as well. So you have all the right pieces in place for this company to have a growing free cash flow. And I think the multiple can expand a lot actually from the past as well.
So, when you talk about a company that has all these government contracts for government infrastructure initiatives, I think about, the headaches that are associated with that say an AtkinsRealis is dealing with the Eglinton LRT and their other projects. Did Bird ever get swept up in that? And are you confident that won't happen again?
Yes, they had some issues in the past. It's a very small portion of the work they're doing right now. And at some point in the future, they're going to have some of those problems as well. But as long as it's within the small margin of the overall business, as long as it's manageable, it's okay. They're still taking the fixed contract work, but they're taking it under all types of assumptions and all types of safeguards in place, which have not been there in the past. So because it's, in my opinion, it is becoming a much higher quality business, I think the multiple should be very different from what it was in the past.
And you prefer Bird to, say, an Aecon, which also plays in construction, but I don't know, is that a real multiple? 157 times. I mean, it's had an insane run up.
Well, you have to look at the EV to EBITDA multiples for this type of businesses. Okay. That's a better comparison. I do like Aecon as well.
You do like it? Okay.
Yes. Aecon is not 100% Canada. They have a big US presence, and they also have a big nuclear exposure. So I do like Aecon as well. It's a great business.
For different reasons.
But for different reasons, absolutely. But they're both buy, in my opinion.
Okay, let's talk about your third pick. Interesting. Capital markets wealth management play, Canaccord Genuity. Most recent results were very robust. Not surprising. Capital markets is awake, finally. And so is wealth management with markets near those record highs. Why do you like Canaccord here? So
Canaccord has been in the penalty box for many years. Right now, I think they're in the best position that I have ever seen this company, and I've been following it for probably 15 or so years. So the capital markets, for example, in Australia, absolutely booming. Investment banking business is great. In Canada, there is much more room for capital markets to perform. We have seen all the financings done by the gold companies, for example. These are coming at very high margin. In US, capital markets for them are just waking up. So that's going to be a bigger contributor, in my opinion, this year and going forward. So overall, capital markets is doing well and will do much better. Actually, geopolitics, uncertainty, high gold prices is helping them as it relates to the funding for the gold companies. And wealth management operations in Canada have done really well. In UK as well, assets are growing. And these are high quality operations. They're not going away anytime soon. What also excites me is that I believe Canaccord needs to monetize the UK wealth operations, and potentially in a very short order.
How would they do that?
There are several ways to do that. You can sell it outright to somebody, and there are all types of precedent transactions we can look at and try to evaluate how much this business can be worth.
Why do you prefer that they get out of it?
Well, Canaccord needs to control the process of monetization of the big stake they have in UK wealth.
Mm-hmm.
The timeline for them to do that is by the end of July of this year. After the July of this year, they're no longer in control of the process. It's a minority shareholder in that business that gets to control the process. If you're in the Canaccord shoes, clearly you want to be the one running the process. At the same time, I don't think you want to take it, to the last month or the last 2 months. So I think it needs to happen literally within the next 1 to 3 months. And this would lead to the big unlocking of the value for Canaccord. So the value needs to be unlocked. The stock is still very cheap based on the sum of the parts valuation. And this is a big part of the equation. There also has been a number of leaked press releases about potential bidders for those assets. Mm. And if you take a look at some of those numbers, you can come up with a potential sum of the parts valuation.
That you don't think is captured in the stock, even with the rally?
In my opinion, it's not. If you apply the multiples contemplated in those press releases, you can read those Reuters articles, you can see that there is quite a bit of upside to the stock price.
Am I wrong, or is there some sort of U.S. regulatory overhang on Canaccord as well? Is that material?
It has been in place for quite some time. They have allocated the capital to that. It's taken a bit longer to resolve that. That's true. I believe it's just a question of time. Mm. It has been an unfortunate, lingering matter. But I think it will be resolved, in a matter of the next few quarters, hopefully.
Do we know what it was related to?
Well, there was, let's say, some aggressive activities they conducted that regulator did not like. And so they have, in my opinion, properly provisioned for that. And once this is resolved, I think this can actually lead to a higher level of activity for the U.S. capital markets activity. So that's another optionality we have in our toolbox.
Okay, Calian Group, Bird, and Canaccord Genuity, the pro picks. Thank you so much, Andrey, for joining us.
Thank you, Amber. It's been a pleasure.
Andrey Omelchak joining us from LionGuard Capital. We're going to dive headfirst into the energy sector. For our next episode, we've got Eric Nuttall of 9 Point Partners. I'm sure you have tons of questions based on the geopolitical events over the last couple of days. Email us questions@inthemoneypod.com, and we'll see you on the next episode.